Good afternoon. On behalf of the Federal Tax Section, this is Thomas Treese of Laird Lyle PLLC, and I'm serving as the current phone czar. Today's speaker is Stephen Hadjilogiou of Baker McKenzie. The topic is International Provisions of the Tax Cuts and Jobs Act. Time permitting, a Q&A portion will follow this presentation. To ask a question during Q&A, press *6 to unmute yourself. A CLE course code will be emailed out to all registrants following the presentation. Steve, you may proceed when ready.
Sure. Thank you, Thomas. As you mentioned, this is Steve Hadjilogiou, international tax attorney here in beautiful, sunny Miami, Florida. I'm joined today with a colleague of mine, the great Keith Hagan, who works with me here in Miami. Before I got started, I did want to say that this call was scheduled many months ago, and the reason to schedule an international tax topic in mid or late December was to act as somewhat of a teaser for the International Tax Conference that's taking place this January 10 through 12. If you haven't registered, now is a good time to do so. January 10 is going to be our International Tax Conference Boot Camp. The boot camp is going to outline all the basics of international tax. For the last 30 years, the basics of international tax have looked fairly similar. I think I'm happy to say that this year, the basics of international tax are going to be turned upside down on their head. So we are probably the very first major tax conference post-tax reform, just based on fortunate timing. So I think our speakers are getting prepared to update all their materials and to provide the basics of international tax as they will exist on January 1 of 2018 and thereafter. On January 9 and 10 is our full two-day conference. It will also heavily involve tax reform in a maybe more high-level setting. Our speakers had already obviously had their topics selected, but now we're going to have a new slant on these topics and how, especially given how tax reform will affect them. So we do have our normal international inbound and outbound updates, and we have one speaker who is going to speak on Grecian magnesite, which has now been overturned or will be overturned, assuming tax reform gets signed into law. And so that speaker will now be presenting on the international provisions of the Tax Reform Act. So during the course of those 3 days, you'll hear in much more high-level detail issues involving the Tax Reform Act and how it's going to affect our clients and our practices. And today I'm going to give you the high-level summaries of the Tax Act, especially focusing on the international provisions. To me, by the way, to register for the International Tax Conference, you can go to www.internationaltaxconference.com. You can reach out to our friendly administrator, Chris Hargrit, or you could just email me at stephenh@bakernet.com. That's STEVENH @bakernet, BAKERNET.com. And we'll get you connected with the right people. So that's the end of my shameless intro. And now I'll actually turn to the meat of the material. So to me, the international provisions obviously fall into two categories. There's the outbound tax provisions, which have a significant effect on U.S. persons that operate and earn income outside of the U.S. And in a more limited fashion, there's tax reform provisions that apply to inbound tax. So I think the major focus of the inbound tax involves sales by foreign distributors to consumers in the U.S. or to affiliated distributors of in the U.S. of a foreign parented group. So let's start at the beginning. Today we're going to talk a little bit quickly about the process and timing. We'll briefly discuss the business provisions, and then we'll get into the main focus, which is the international. As you've probably seen in the news, the House voted in favor of the legislation yesterday. The Senate also has now voted in favor of the legislation, but due to a bird rule issue, the House is now slated to revote on the bill, likely today, and thereafter, sometime today, the White House is set to inform us as to when President Trump will sign it into law. It seems likely, based on everything he said, it will be signed in sometime around Christmas, since it is our greatest Christmas gift for the middle class, as he's told us repeatedly. So I would expect that maybe as soon as tomorrow, Trump will sign it into law, but it might get pushed until next week. And there's been even some chatter about it getting signed after the new year, although I would think that would be unlikely. So moving on, there's been a lot of talk for the new rates that apply to partnerships and corporations and for individuals in general. I think for our entrepreneur type clients or our high net worth type clients, many of them operate flow through entities. That tax rate can get reduced down now to a maximum rate of 29.6 based on a 20% deduction that would apply against the new highest ordinary income rate, which is set to be 37%. On the other hand, the maximum corporate rate is now set to be reduced to 21%. That obviously is a significant reduction from the current 35% max corporate rate that exists. So, a lot of our clients, domestically and internationally, are asking the question of whether it makes sense to convert a partnership to a corporation, considering that the corporate rate is now lower than the partnership rate, 21 versus 29.6. And I suppose one thing that clients should always keep in mind is that the corporation or the shareholder is still subject to paying a dividend tax to the extent a C Corp pays a dividend to the shareholder, so that ultimately the effective rate on corporations' income after distribution to the shareholder will be still higher than the pass-through rate of 29.6, because the corporate rate of 21% would apply at the corporate level, and there's been no change to the qualified dividend rules or the 1411 Medicare tax, so that dividend distributions from a C Corp to a domestic shareholder are still subject to the maximum rate of 23.8%. Some other interesting news is that the corporate AMT has been repealed, and the individual AMT has not, but it has been reduced in application so that it applies on less types of income, or only higher amounts of income can be subject to the individual AMT. Moving on, I'm now on page 8 of my materials, and this is one of the first and maybe the most significant international inbound tax provision that applies to many of our clients, especially our clients that are foreign parented entities or foreign individuals that are investing in U.S. real estate or otherwise investing in U.S. businesses. A popular technique is to use portfolio debt stripping, which allows for interest to be paid to foreign persons, tax as a deductible expense to a U.S. corporation or partnership, and it's not subject to U.S. tax on the interest component paid to the foreign person recipient of the interest payment. This new rule is a replacement to former Rule 163J, which generally disallowed certain interest expense deductions if a corporation had a debt-to-equity ratio of greater than 1.5 to 1. That rule has now been changed, and it now applies to not only corporations, but to any taxpayer that's taking interest expense deductions. And the new rule effectively says that for the next 4 years through 2021, that the interest expense deduction is limited to 30% of EBITDA. After 2021, they make it a little tighter, and they say it's limited to 30% of EBIT. So there will be a tightening of the amount of interest expense that can be incurred by a U.S. person or business, especially using some of the common techniques that we generally use for our non-resident person clients, combining that with the portfolio debt exception. The other inbound provision is the what's known as the BEAT, and we'll get into the BEAT towards the end of our presentation. Did I miss anything, Keith? I did miss something. There is a exception to this 30% tax for real estate investment.
And also that 30% is above and beyond any of your business interest income. So to the extent that the taxpayer has a lot of income from loans it makes, so from interest, that 30% is above and beyond that. So that 30% applies only to its non-interest income. And there's an unlimited carry forward. So.
Okay. Net operating losses, carrybacks have been repealed. Carry forwards are limited to 80% of taxable income for years beginning after 12/31/17. So no longer can you fully deduct income in 1 year from a net operating loss carry forward. There's always going to be a haircut of 20% and tax owed to the extent there's income in 1 year and an NOL from a previous year.
Yeah, so basically just slows down your ability to use up NOLs.
Yeah. In exchange for moving on to page 10, in exchange for the reduced corporate rate and reduced individual rate, a significant amount of deductions have been eliminated from the law, and most credits have also been eliminated. They did retain the R&D credit, which was designed to encourage research and development occurring here in the good old US of A. So they did keep the R&D credit. So from there, let's move on to the meat, which is the international provisions. Like I said at the beginning, the major change is in outbound taxation, specifically individuals and corporations that operate overseas frequently create subsidiaries in the foreign corporation. Those subsidiaries are often considered controlled foreign corporations if U.S. shareholders who own more than 50% of the foreign corporation. So most of our clients who are operating overseas wholly own the foreign corp, or they own the vast majority of the foreign corp. And so we frequently have clients that are operating in foreign jurisdictions that through a foreign corp. And the reason this was generally done is if you were able to avoid, if the foreign corporation was earning income that was not considered subpart F income, then there'd be no immediate taxation to the U.S. shareholders. The reason this was a great benefit is that frequently with planning overseas, the tax rates of the foreign corporations could be quite low. I'm sure you've heard stories in the Wall Street Journal and elsewhere of all these major multinational corporations paying tax rates of 3% to 10% in that range. And that is not an inaccurate statement. I think a lot of clients are paying tax rates. Generally, we see a little higher than that, maybe 8 to 10% effective offshore tax rate. So under current law, an individual or a corporation could create a subsidiary foreign corp, and with proper planning, that foreign corp would pay an effective rate of, let's say, 3 to 10%, and they never pay a dollar of U.S. income tax until that foreign corporation made a dividend to the U.S. person that owned the shares in the foreign corp. Generally speaking, when that dividend was paid to the U.S. person, the tax could be, if it was to a C corp, the tax would be a 35% rate. And if that dividend was paid to an individual, the tax would either be a qualified dividend at 20% plus the 3.8% Medicare rate if the foreign corporation was formed in a treaty country. And if it was not formed in a treaty country, then the tax would be the ordinary income rate, which was a max of 39.6. And again, the Medicare tax of 3.8 would apply on top of that to make it an effective tax rate of 43.4%. So now what's happened is that they're turning this, the normal way that the world operated upside down, and they've turned to what they're calling a territorial tax system. So what does that mean? What they've now said is that if a C Corp owns a CFC, or even if a C Corp owns 10% or more of a foreign corporation, it can receive a dividend from that foreign corporation without incurring any U.S. income tax liability on that dividend. So for C Corps, where it used to be a 35% rate on receiving a dividend from a subsidiary foreign corporation, the rate has dropped to 0. So that's a huge change. For individuals, they have not changed the taxation on dividends at all. So it's still the 23.8 or 43.4% for dividends received from a foreign corporation. One thing that you should keep in mind, though, is that under the current law, most of the time when a client has planned into creating a foreign corporation, they've planned it in such a way that they will not be subject to Subpart F income. If they were subject to Subpart F income, they wouldn't be able to defer the tax at all, and it would have been treated effectively as if the U.S. shareholder received that income directly. Under the new law, they've created a new Subpart F provision that's going to be much, much, much more difficult to avoid, and it seems likely that a significant amount of earnings of a foreign corporation will now be subject to Subpart F, and we'll get into that in a little bit. So based on the description I just gave you, you can imagine that a lot of these shareholders that have of CFCs and the CFCs are paying tax at a relatively low rate, but the dividends paid out are taxed at a very high rate, have decided they're just not going to pay dividends. So it's been a hot topic in the press and among politicians for years, the so-called trapped cash that exists in foreign corporations. And so what the new law initially does is it says, well, we're going to impose a transition tax so that all these earnings that have been building up over the last years will now be forced to be repatriated, but we're going to give you a special rate on that forced repatriation. So individuals and C Corps are going to effectively be subject to this transition tax based on the earnings and profits amounts of the foreign corporation as they existed on either November 2 of 2017 or December 31 of 2017, and the tax will be imposed on the higher amount of earnings and profits of the foreign corporation on either of those two dates. The tax rate that applies is dependent on the composition of the assets as they effectively existed in November 2 of 2017. And so basically the way the rule works is if all the earnings of the foreign corp were reinvested in non-liquid type assets, so imagine foreign corporation earns income and reinvests it in the business by building a new plant, those earnings will be taxed at a lower rate, which is 8%. If the foreign corporation instead took that cash from its profits and stuck it in the bank or reinvested it in liquid type assets, then this transition tax applies at a higher rate, which is 15.5%. Technically, the way the code works, or the provision works, is the tax flows through to the shareholder at their ordinary income rate, and then it provides a deduction in an amount that'll result in the individual or the corporation paying a 15.5% or 8% tax. to the extent the foreign corporation has paid tax in the home country, a C corporation is allowed to offset the 15.5 or 8% tax with foreign tax credits, but they are limited in how much credit they can obtain or use depending on the composition of their E&P as either liquid or non-liquid. So there is a foreign tax credit available, but it's limited. Unfortunately for individuals, they do not receive the benefit of any foreign tax credit paid by the foreign corp. So they effectively get to use the foreign tax paid as a deduction, but not as a credit. Obviously, a credit is much more valuable. So C Corp advantage, C Corp in that case. As you'll see as we go through, you're going to see a lot more advantages to C Corp versus individual. The other issue, nice or friendly provision in this transition tax is that taxpayers can elect to pay the liability in installments over 8 years, and those installment payments are backloaded. And what I mean by that is that they pay 8% of the total amount owed for the first 5 years. Then in year 6, they pay 15%. Then in year 7, 20%. And in year 8, they pay 25% of the amount owed. One fairly unique extra benefit that could apply if the foreign corporation is owned by an S Corp is that there's a special deferral regime which defers the timing for when the 8-year period begins to run. And effectively what this means is that if the CFC is owned by an S corporation, the shareholder of the S corporation, and this is an election made on a shareholder by shareholder basis, can elect to defer to pay the tax indefinitely until a triggering event occurs. There's 3 triggering events. The first applies if the shareholder sells, liquidates, dies while owning the S corporation. So if they sell the S corp, they liquidate the S corp, or they die, that would be a triggering event that starts the 8-year installment period. The second one says if the S corp sells, liquidates, etc., the CFC, then the triggering event also occurs. And the final triggering event is change in S corp classification. So if the S corp converts to C corp, then you could also have a triggering event which would begin the running of the 8-year period. There is a few other interesting provisions. They've extended the statute of limitations for 6 years, presumably to have extra time to review taxpayers' books to make sure they calculated this transition tax properly. And then there's another rule. So if a taxpayer were to defer this tax, or simply if a U.S. individual taxpayer was subject to this tax and they expatriate within 10 years, then any of the deductions, meaning you look at the ordinary income rate that would apply to them, 39.6%, less the deduction that got them down to a 15.5 or an 8% effective rate, they must pay a tax instead of 35% on the entire inclusion amount. So if an individual is subject to this tax, they expatriate within 10 years, then they have to pay the difference effectively to make it an effective rate of 35 rather than 8 or 15.5. interesting fact pattern that we had been discussing internally is, a lot of our clients would be subject to this tax on, effectively triggers on December 31 of 17, unless they have a fiscal year taxpayer. So if they're calendar year taxpayers, it's December 31, 17. And so once this tax is triggered, it converts all of the E&P to what's known as previously taxed income. Previously taxed income means, or any E&P that's been converted to previously taxed income can be distributed from the corporation to the shareholder on a tax-free basis. So once this tax gets triggered, even if the taxpayer is on the installment method, or even if the taxpayer is an S-corp and has deferred payment, they can take the cash out of the CFC as a distribution thereafter. So, our clients can now take any of this so-called trapped cash out of the E&P without incurring any further tax, even if they're on the installment plan, even if it's deferred by S-corp status. So it's a pretty nice benefit. But one thing to keep in mind is many foreign corporations are incorporated in countries that impose a withholding tax on the distribution. Generally, under U.S. income tax treaties, the lowest rate that can apply to individuals is 15%. So we see frequently countries imposing a 15% withholding on the cash out, because if you have a scenario where a client pays cash out of a CFC that's PTI in 2018, the foreign country is going to consider that a dividend, apply the withholding. On the other hand, the United States is going to consider that to be a return of basis transaction. That's a non-income event. What results is that there's a mismatch when you're trying to claim a foreign tax credit against that foreign tax paid on the dividend out. And there's a code provision that's going to become a lot more important, and that's 960B, which basically fixes the mismatch of timing so that your foreign tax credit limitation under Code Section 904 does not result in a big zero on the amount of foreign tax credit that would allow the shareholder to claim, because there was a previous year inclusion, which was the transition tax, and a subsequent year distribution. So 960B fixes the mismatch and should allow the shareholder to at least get a significant amount of that foreign tax credit credited against their income. Specifically, and then of course, as I mentioned, there is the haircut provision. So even if 960B applies, that foreign tax credit likely is subject to the haircut that is discussed in my third bullet on page 12.
Yeah, and this is why they drafted this repatriation tax in that funny way. Instead of saying the rate is 8% or 15.5%, they say you get a deduction to the extent that the math works out to where you reach a 15.5 or 8% rate, because this haircut is tied to that deduction. And so the haircut is effectively there to line up the amount of the foreign tax credit limitation calculation that 960B gives you to offset the mismatch. So the deduction to get to the 15.5 or the 8% rate also works to limit the increase in the 904B limitation.
Right. So as you can see from the transition tax, C corps and individuals are generally in the same place, with the exception that the C corp is allowed to offset the tax with a credit for the tax that the foreign corporation paid, whereas an individual is not able to offset the transition tax with a foreign tax credit for the taxes paid by the corporation. Both a C corp and individual can offset tax to the extent there is a withholding applied on a dividend distribution. So C corp does have a slight benefit here because they can use that foreign tax credit. That said, if a C corp has an income inclusion under this transition tax, that'll be included in the C corp C&P, so that a subsequent distribution of cash from the C corp to an individual would be subject to the normal ordinary or qualified dividend rates of 23.8. So it's not necessarily recommended, I don't think, to try to put an individual who owns a CFC to own it through a C corp before year end because of that E&P inclusion that would apply to the C corp. You should keep in mind that shareholders that own the CFC through an S corp do get the benefit of the indefinite deferral of payment of the tax. We're still taking a closer look at how and if interest charge may apply in the case of a deferred tax under the 8-year payment plan or the S corp indefinite deferral. Our initial thinking on that is that there is no interest surcharge, but don't quote me on that one yet. So the transition tax, we're now moving on to page 14, was a transition tax to move us into this territorial tax system. As I mentioned, the territorial tax system is really, we're not really a territorial tax country, because a territorial tax country would say that any foreign sourced income is simply not subject to tax to any U.S. person. This tax reform does not do that. A U.S. person that operates directly in a foreign country is still subject to tax on their worldwide income. What this territorial system is a participation exemption. And what does that mean? It means that a C corp that receives dividends from a foreign corporation gets 100% dividend received deduction on such dividend. So if a CFC avoids subpart F income on its earnings, which includes the new category of subpart F income that we're about to talk about, then the C corp can receive a dividend from the foreign corp on a tax-free basis. As I mentioned earlier, individuals don't get the benefit of this participation exemption, and to the extent they're earning dividends from a CFC and that CFC is avoided subpart F income, they're still paying tax at rates of either 20% plus Medicare or 37% will be the new rate, the max rate, plus the Medicare tax. So if a C corp receives a dividend, they will not pay a tax on that dividend from the foreign corp. This applies to CFCs or to 10% or greater owned corporations. No longer, we have done away now with the Section 902 foreign tax credit, which makes sense because the 902 tax credit was effectively a tax to offset, or a credit to offset the tax on the receipt by a C Corp of a dividend. Since C Corps are no longer subject to tax on dividends, they don't any longer need the 902 credit. Subpart F does remain intact, except they've eliminated foreign-based company oil income category, which I imagine for us in Florida is a relatively obscure provision. And they did add a new category of Subpart F, which is the global intangible low-taxed income, which is known as the GILTI, and they've extended 954C6 through the year 2019, which is something that Congress has been doing for the last 5 to 10 years, which is extending 954.6 for 2 years at a time. So this is a great system, especially if you can avoid Subpart F income. The problem is that I don't think that many foreign corporations can any longer avoid Subpart F income because of the GILTI. And the GILTI, let's skip to page 19. So that what the GILTI is a new type of Subpart F income. And in a nutshell, the GILTI is an amount that equals the following formula. Basically, it's the foreign corporations' income or profits less 10% of an acronym they call QBI. QBI is effectively the adjusted basis intangible assets of the foreign, owned by the foreign corporation. So you take, if the amount of the corporation's earnings exceed 10% of the corporation's basis intangible assets, meaning things like machinery, real estate, something you can touch. If that number exceeds 10% of the basis in those assets, minus certain interest expenses, then that income will be subject to Subpart F income, what is now known as GILTI. GILTI is imposed in the code in a new code section, which is 951 Cap A. GILTI for C Corps, a GILTI inclusion for a C Corp is provided two very nice benefits. One, the GILTI inclusion can be offset by foreign tax credits paid by the foreign corporation, less a 20% haircut. And two, the income inclusion to the C Corp, they provide a deduction of half of the C Corp's tax rate. So basically the C Corp pays a tax on the GILTI inclusion of only 10.5%. And they get to offset income with an 80% haircut with their foreign tax credits. So if you do the math, what this effectively means is that if the controlled foreign corporation pays an effective rate in their home country of 13.125% or greater, the GILTI inclusion will result in zero additional tax owed in the U.S. to a C corporation shareholder of the CFC. Unfortunately, for those of us that work a lot with entrepreneurs, the results to individuals that own foreign corporations, and by the way, when I'm talking about individuals that own foreign corporations, I'm talking about individuals, trusts, or trusts or individuals that own CFCs through flow-through entities such as partnerships or S-corps. So any of those ownerships in a CFC have a less desirable result. So what happens to those people? The guilty inclusion still applies. The code does not provide for a 50% deduction on their tax rate. So where a C Corp pays a 10.5% rate on a guilty inclusion, an individual pays a 30, or a trust pays a 37% rate on a guilty inclusion. And the guilty inclusion for an individual does not, there's no offset with foreign tax credits paid by the foreign corporation. So effectively, a U.S. individual could pay rates on a guilty inclusion of in excess of 50% if there's a relatively high foreign tax, plus their 37% U.S. tax rate. The one thing that could be a savior to individuals that own CFCs is the 954B4 high tax exclusion, which apparently does apply to the guilty inclusion. And that basically says that if the foreign country imposes a tax that equals 90% or greater of the highest U.S. corporate rate, that foreign corporation cannot have any Subpart F income. And so the guilty seems to fall into that category. It seems that they have incorporated 954B4 so that if what that means is 90% of our highest corporate rate, which is 20%, is 18.9%. So if the CFC is subject to an effective rate of 18.9 or greater, then the guilty tax wouldn't apply to an individual. So a C Corp has no guilty tax if the foreign rate's 13 and an eighth, whereas an individual wouldn't have a guilty tax if the effective offshore rate is 18.9. Seems a little unfair.
But you also get a bigger bonus or a bigger benefit on the individual side compared.
So I mentioned to you earlier Section 960B. When I first started looking at these guilty inclusions, I said, wow, 960B is going to become really, really important because most of our clients impose a withholding or hit with a withholding tax by the foreign corporation when the foreign corporation pays a dividend. Unfortunately, 960B only applies to 951 Subpart F inclusions, and as I mentioned a few minutes ago, guilty is imposed under 951 Cap A. So it doesn't appear that corporations or individuals are going to get any tax credit relief if a foreign country imposes a withholding tax on dividends paid out on E&P that has become PTI because of a guilty inclusion. So it could be a bad result for C Corps, but an especially bad result for individual shareholders of a CFC. The corollary to the guilty, which is a benefit to U.S. corporations that sell goods or provide services that are, they sell goods for consumption outside the U.S. or provide services to property or people outside of the U.S. is what's known as the foreign derived intangible income. So if a C Corp operates in that capacity where they have significant consumption of their service or good outside of the United States, the new code is going to provide for a deduction on the corporate tax to bring them down to an effective rate of 13 1/8, which will subsequently increase to 16.406, a very precise percentage there. In 2026, it only applies to domestic corps, and the formula is a little convoluted, but effectively they've come up with a proxy to determine what's supposedly intangible income of a domestic corp, but it really, like the GILTI was supposed to only apply to intangible income of a controlled foreign corp, but in both of these they've created a proxy, which is that 10% of QBI proxy. And so, I think the FDII can be a nice opportunity for smaller businesses that don't have the ability to create foreign corporations like the big boys do, to effectively reduce their rate to 13 1/8% on income earned for products or goods that are consumed outside the U.S. As far as I can tell, this FDII is somewhat like a supercharged IC disc, because the IC disc rules generally looked at where products were consumed. This new rule now allows services to also be consumed offshore, and it doesn't have all the limitations that the IC disc used to have. So even those people or those clients that are operating through pass-throughs, I think can create C Corps to take advantage of this rule. So something definitely to take a closer look at it if you do have clients that are selling goods or services for consumption outside of the U.S. And then we're just going to jump along here to I think the biggest inbound provision, and I'm going to turn it over to Keith for, maybe we can do this fairly quickly so that we can open it up for at least 5 minutes of Q&A.
Yeah. So the base erosion anti-avoidance tax, the BEAT, basically operates like an alternative minimum tax for income which is paid out as a deductible expense to foreign-related parties. And so whenever I first read it, I thought this is going to have a huge impact on lots of folks investing in Florida from abroad. And if they're wealthy enough, it might. So there's a limitation on it that will sort of curtail that. But basically, the BEAT in a nutshell says that there's a 10% tax on the taxpayer's modified taxable income, which basically is their over their regular tax liability, which is basically, and the modified taxable income is basically their taxable income, where you add back what they call base erosion payments, which are deductible payments to foreign-related persons. So typically it'll be interest or royalties, but it could also be things like depreciation deductions from depreciable property that the taxpayer might purchase from a foreign-related party.
So just to give an example, if you had a U.S. C Corp subsidiary of a foreign corp, and that C Corp was paying interest payments to the foreign parent. It's paying guarantee fees to the foreign parent, and other kind of typical base erosion type payments that result in a deduction against U.S. tax liability and income to the foreign parent. This provision provides an alternative minimum tax by looking at the income of the U.S. party basically before taking deductions for those related party base erosion payments. And if it's over, 10%, if the tax liability that applies under normal rules is less than 10% of that alt-min tax,
then you pay the difference.
Right. But the kicker is the limitation.
Yeah, the limitation. So it seems like this beat is specifically targeted at, I guess, foreign-based multinationals, because it only applies to taxpayers who have an average of $500 million of gross receipts over the past 3 years. So
annual gross receipts of $500 million.
Yep. Yeah. So the vast majority of folks investing from abroad in the state or in the U.S. in general will sort of be exempted because of that limitation. But if you have a foreign-based multinational, this is something that can come up.
So I think, thanks for that, Keith. I think in a nutshell, since we're running short on time here, to me, it appears that if you do represent clients that are individuals or trusts that own CFCs, you probably are going to need to restructure how they own, because the individual tax on guilty income is just punitive compared to how C Corps are taxed. You should consider the FDII if you do have a client that's selling goods or services consumed offshore. And, to the extent you represent inbound clients and they strip income out with interest payments, the new 163J provision needs to be considered. And to those of us that represent clients that sell significant amounts of goods into the U.S. or importing goods into the U.S., the beat is something that definitely needs to be considered. And then the final point, which we didn't really touch on today, but it's something that you should consider, is if you are representing a client and they're operating internationally through flow-through structures, this new rule might encourage them to convert the flow-through structure to a corporate structure based on the fact that they could reduce what otherwise might be a 37% tax to something like a 10.5% or even 0% tax, depending on the offshore effective tax rate. So really, the main gist of this new law is affecting outbound transactions, but there also is some inbound component to it. It's 1 o'clock. I apologize, they've gone long, but if there's still time, I can open for Q&A.
Yeah, Stephen, listeners can press *6 to unmute themselves.
I've got a question in discussion of the relative disadvantage of the individual ownership of the controlled foreign corporation with respect to the rules that we were just discussing. Seems like there would be implemented some kind of anti-abuse regulation to prevent that simple change to corporate ownership of that controlled foreign corporation.
Well, I don't think it's abusive. There's an economically significant change in the way the entity's owned. and this is simply the way that Congress has decided they want to invoke the tax code. You should also keep in mind that just because corporations get a better rate, converting to a C Corp results in an additional layer of tax, which is the C Corp, when it makes a distribution to its shareholders, is going to pay tax. Shareholders will pay tax on dividends. So I'm not overly concerned about some sort of anti-abuse provision on contributing.
Will you see? Do you see any changes in the current 30% withholding 1042S reporting structure for outbound taxable income to foreign entities subject to this, either intercompany, or not?
No, there's been no changes in the withholding regime in 1441, or no change to FERPTA. So no.
Well, that's good news. Thank you.
Is potentially if you're paying interest out, the new 163J could limit deductibility of interest.
What about foreign tax credit on individuals?
901 is still available to individuals.
So all the retirees with creative investments and all that, they get all their foreign tax credits?
Yes. Yes. The 901 credits are disallowed only to corporations to the extent they're subject to a withholding tax on dividend income that's excluded under the participation exemption.
Gotcha. Thank you.
Steve, where's the new 10% withholding tax from Grecian magnesite repeal?
Where is it repealed?
I've been looking for the language. There's a new 10% withholding tax, and as a result of the repeal of Grecian magnesite. Did they stick it under 1446 or where? I can't find that yet.
I'm not aware of a 10% withholding tax based on repeal of Grecian magnesite.
Yeah, I've seen there's been references to it. I just can't find where they stuck it under what code section. It looks like it's.
There's also references to information reporting tied to that, but I can't find it either. I've been trying to find it.
There is a repeal of Grecian magnesite. I imagine it's all in the same provision.
Yeah, so hope so, but whether it's a new code section or what, remember there was never such a withholding tax before, except perhaps under 1446.
My understanding of what they did, and I quite frankly haven't spent a lot of time looking at it, is they've effectively said that a non-resident sale of a U.S. partnership interest is treated as ECI, subject to U.S. income tax.
Right.
So that's the repeal of Grecian magnesite. I'm not aware of a corollary 10% withholding, although...
There definitely several articles have mentioned it.
Yes, it is. And the thing is, the 1446 provision, it makes sense it should be there because that's the default withholding provision for ECI, but I can't find it either. And I have seen it, and it ties to a reference for information reporting, a new information reporting requirement. And it's not clear from what I can read. I went back and pulled the published statute and the committee reports on it, and it just makes references, but I can't find it anywhere. I agree with you. There's something out there. We just got to find out where it is.
I would think it would fall under 1441 generally only applies to FDAPI.
Right.
Yeah, it's not there. It's partnership related, and I agree with you. It's a 1446 kind of problem. But if you look at the backtrack, the cross-check for code reference changes, 1446 is not referenced as a change code provision.
Well, we'll take a look. Any other questions?
Other than the insurance change, has there been any change whatsoever to PIFIC?
Good question.
No.
I think that was the only one, Jason.
Jesus, you think they would have worked on that one with so many open questions.
Oh, my, yes.
No.
All right.
Yeah, Steve, I had a question. with respect to implementation on an individual level, I know there were comments on the EMP rules that they're going to check to see, on game playing with check the box elections. Is there any reason that you can think of to not put an LLC between an individual and a CFC so that you could potentially retroactively create an S corp to get the benefit of the payment deferral?
That would be a very smart thing to do by the end of the year.
Yeah, no, I came up with it.
Yeah, no, I mean, that's what we're working with our clients on doing.
Well, be careful on the treaty provisions in that, because you'll kill yourself on the LOB provisions if you're using treaty safety.
Mm-hmm. Yeah, most of the places that we're talking about, we're usually not talking about a treaty jurisdiction. My biggest problem is we have individually owned CFCs that have been inherited over courses of years, that the company may have been in existence for 40 years, 50 years, and without a better defined amount of earnings and profits that are going to be included, there could be earnings and profits that are tied into operating assets that could have to be picked up by these individuals, and obviously having an S corporation in between would allow us to defer the payment until they actually get money. And so, that's how I'm just trying to think outside of the box, because otherwise they're going to have 8 years to pay off something that they don't have any money to pay.
John, actually it's even better than that. A triggering event to pay the tax is not a distribution of cash. You can actually pay the cash without triggering the 8-year period.
Yeah, I guess I didn't focus on I knew like selling the company, and I just didn't focus on the triggering events. But yeah, it's
selling the company, selling the S corp, so selling the CFC, selling the S corp, dying, or converting the S corp election to a C corp election or to a partnership.
Mm-hmm. And just tying into that, was there something? Did they finalize? There was something that I think was reserved, where they were talking about making NRAs eligible to be beneficiaries of SBITs. There was something in the legislation, but it almost was. I think it was written like they didn't do anything about it, but it was in the committee report.
Surprise.
You know what? I should point out two interesting things. One is, we talked briefly about LOBs. Individuals that own non-treaty country CFCs obviously pay tax at the ordinary income rate on dividends. If that CFC gets dropped into a corp, you no longer care whether there's a treaty or not. You want to avoid a withholding in the foreign country, but when the C corp receives a dividend from a non-treaty country CFC, that dividend is zero, the same as it would be if it came from a treaty country. And then the dividend from the C corp to the individual is qualified dividends because it's coming from a C corp. So you can effectively magically convert ordinary dividends to qualified dividends by interposing a C corp, as long as you feel comfortable that it wasn't an abusive transaction. The second interesting point I think you should pay attention to is to whom the transition tax applies. Individuals it applies to C corps that own CFCs, and it also applies to C corps that are considered 902 shareholders of a foreign corporation that's not a CFC. With respect to individuals, it applies to individuals that own a CFC or that are U.S. shareholders of a CFC. It also applies to individuals that own or are considered U.S. shareholders of a non-CFC if any domestic C corp is also a U.S. shareholder of the foreign corporation. So you could have a situation where you have an individual that owns 10% of the vote or more of a non-CFC being subject to the transition tax if any C corp owns 10% or more of the vote of that same foreign corporation.
Sounds like
unrelated.
Nightmare.
Yep. Say, Steve, has anybody in your shop?
The publicly traded PFCs and how difficult brokerage and banks have in compliance mechanisms to deal with their customers who invest in them. This could be a nightmare.
Well, you'd have to have
and it could truly blow a lot of systems I work with out of the water in that area.
You'd have to have 10% of the vote owned by the individual. So.
But that happens. You'd be surprised how frequently that happens. We deal with PFIC issues all the time.
Yeah. See, Steve, there's been quite a bit of noise out of the EU about some of these provisions violating some of our obligations. Has anybody in your shop done an evaluation yet as to how serious that is?
Good question.
The biggest EU complaint was against the House version of the BEAT, which was an excise tax, and that's been canned and replaced with the BEAT.